Good morning, everyone. This is Teddy Kekstadt from Forex Trading Unlocked, and we're here for our morning Forex breakdown sponsored by the Nadex. And real quick, we just want to go through our disclaimers. This is the Forex Trading Unlocked disclaimer, which just basically tells you that this webinar is for illustrative purposes. And then here's the Nadex disclaimer. You can take a look at that. And once again, it's the same thing. It says it's basically for illustrative purposes, educational, and that is it. So with that, let's move on to our first slide. So today we're going to talk about a lot of things basically revolving around the US dollar. We have an FOMC meeting that is today at 1:15 Central Standard Time will be the end of the meeting, and we'll find out what happens. There is a rate cut that is on the table, but not for today's meeting, but sometime between now and the end of the year. I've heard varying percentages, but it's somewhere between 65 and 85% chance of at least one cut between now and the end of the year, and there's, I think, a 40% chance of possibly two cuts. There's a lot of different varying opinions on whether we need one or not. Are this potential rate cuts preemptive? Right now, we have a strong economy that even globally, though they're talking about slowdowns, you're talking about a slowdown off of an overheating economy globally. So it's not necessarily a bad thing, and it's not really the reason to start using bullets like cutting interest rates, but we're not Fed policy makers, so who knows what's up on that. So for the US dollar, today we have the FOMC meeting today, and then tomorrow we have jobless claims, and then on Friday we have existing home sales. All of these three numbers are currency related because of the fact that they're very interest rate related. Right now we have the dollar index, which has been rallying for the past week and a half or so, and then we have also the treasury market, which has been rallying for actually months and has continued to rally into this week and this FOMC meeting. So today's results at 1:15 could be very volatile in what happens, because anything that shakes up the interest rate market will trickle down into the currency market as well as the equity markets. And then also for this week we have the Euro PPI that was today, which will definitely have an impact on the Euro, US dollar. And then we have for the British pound also retail price index, PPI and CPI from today. Tomorrow is retail sales. These numbers are kind of big because we've had varying opinions and analysis as far as how the economies in both the UK as well as the EU are doing, and especially because we have the Brexit going on and other things in the EU with their own political and economic issues. So these are the numbers to pay attention to. All of them obviously have an impact on the US dollar, but the pound and the euro, these are big numbers, and they are the biggest weight in the dollar index. So they are the strongest of the major currency crosses. So as far as what can happen to dollar strength and weakness, that will be reflective of what happens with these reactions to the euro numbers and also the British pound numbers. So with that, let's go to our first chart. And before we get into the currency crosses, I just want you to take a look at the dollar index so you can have kind of a view as to what is going on right now. So as you can see, the market had been, it's basically been in a rally for a very long time, but at the end of May, we had a very harsh sell-off in the dollar index, and obviously there was a gain in the other currencies against the dollar. Now, since the beginning of June, we had a bounce, and over the past week and a half, and even today, this chart is actually just about 25 minutes ago. So you can see that that last green bar there, which is in between those three yellow pivots inside our target range for the Dixie, today it's had a very wide range. It basically came close to the low of yesterday. It's obviously higher than yesterday, as well as it's extended through that pivot range. It basically is encompassing those three pivots between 97.37 and 97.70. So it's not actually the biggest range, but that is a pretty good stopping block for what's going on, especially since we have the FOMC meeting. So over the course of the next few hours, you're most likely not going to see anything else occur because until 1:15, the market's going to probably just basically be flatlining. Now, as far as what to expect for the bulls, I would say you want to see, if you want to see a more dollar strength, if you're shorting the other currencies against the dollar, whatever currency cross that may be, then you would be hoping for a rally above that 97.70 pivot level, that upper yellow line, and pushing up into that downward sloping resistance from the current downward trend. Now that would be a very strong area where you're probably going to see a very big fight with a lot of selling pressure coming in. Only a really big announcement that's off of expectations that would favor the dollar would probably push the market above that blue slanting sloping line and into higher move highs. When the number comes out, there could be a head fake, so be very careful of a spike. The close of today would be, I would say, for most traders, is where you really want to get your bias. Now, if the market was to close above that yellow pivot or above that blue, downward sloping blue line, that would be a very bullish indication of the dollar strength. I personally don't think that that's going to happen. I think the most likely you're going to see it settle somewhere in this target range after today. But like I said, if we don't know what kind of news is going to come out, so if there's something that's especially bullish to the US dollar, then that would most likely cause that scenario. And if it's not necessarily bearish to dollar, expectations are already into the market as far as what the Fed's most likely going to do. So if they don't change their tone, I would say that the market will stay in this range or possibly retreat back towards that lower pivot today. Now, the biggest thing to look out for is there a turn in the dollar? Now, once we get to these other charts with the different crosses, that's what we're going to start to talk about. And I think that if you key off the dollar index, any type of retreat today, like a negative close possibly, or tomorrow, falling back below that 97.37 pivot level, then I think you're going to start to look towards that critical pivot at that purple dash line at 97.02. So with that, let's go to our next chart so it'll all make sense. So here's the Euro US dollar. This is the one of the currencies that we're going to talk today that's kind of flat. Now, if you look at the range, it looks like that there's a lot going on recently because you had that rally and now the market's been breaking for the past week and a half into this probable range that we're looking at. Now we see these lower pivots and at 111.78 and 111.35. That's probably a very good range for the market to settle into for Euro US dollar bears. Now there's that upward sloping blue line. It's a very weak short-term support line. That obviously is right there where that lower pivot is. If that gets taken out, then we're probably looking at Euro US dollar weakness, which means that that dollar index that we were just talking about is rallying. So that's US dollar strength. So any major breakout to the upside in the US dollar index would probably most likely push the Euro US dollar below that 111.35 pivot and down to newer move lows and continuing the bear market that the Euro US dollar has been in for months. Now, is that going to happen? Who knows? I think most likely, because of what we're looking at with the G20 meeting coming up next week, is that the market will be contained in that probable range. After that, it's probably going to settle up and be in a range trade, basically wedging in between these two sloping blue lines. The one is the downward sloping resistance that's been carrying this trend lower for the past couple months. That's why I said that lower blue line is very weak, because right now it isn't a bear market, even though it's had a corrective rally over the past basically half a month. So that being said, after today's numbers, where's it going to go? Well, most likely, especially if the dollar is neutral to starts to pull back, then it's probably going to stay about where it's at. And then I look at that upper purple dash line there, that 112.64 level. If the dollar index begins to retreat, meaning dollar weakness, that would most likely encourage Euro US dollar strength. The euro being one of the two biggest components next to the pound. If the dollar starts to move strongly in one direction against the basket of currencies, typically the majors are the ones that definitely get a nice impact from that. So that would mean that the bulls, if this case scenario is what would happen, if you can get a breach of that 112.64 level, then that rally would probably spark a fresh buying momentum that would push it towards that long-term downward resistance line that's sloping down there at the top of the chart off of that recent high. That would be a very interesting area to see what happens, because if the bulls can get up to that level, also most likely that means that the US dollar index is retreating, That means that this current trend that is, I think, most likely going to be neutral because of what's going on with Brexit and certain political and economic issues in the Eurozone. There's no reason for this market to really break out to the upside heavily or to the downside. Even if you look on this chart, the low is just above 111 even, and the highest area is around 114. That's a $3 range for a 4 or 5 month trading period. So that means that's not much activity as far as volatility for a currency, and especially like there's trending, but you're talking about $1.50 to $2 moves basically, which is next to nothing in a market such as this. So that being said, with the G20 meeting coming up next week, even if the bulls get a rally above that little area there at 112.64, I think your expectations should be very restrictive. Now that high that we had a couple weeks ago back in the beginning of June, if that level gets taken out, then that would signal that we are no longer on the long-term bull campaign and the market is in a neutral to higher trending situation. So we'll see what happens. I don't think that's going to happen. I think you're going to be contained and wedging further because we have not only the G20 meeting coming up next week, but then we have holiday markets coming up again around the 4th of July in the US dollar. So there's a lot of reasons for, besides the fact that politicians are on vacation, traders are on vacation, and unless there's any major shakeup in the tariff deals between the US and China and other countries, as well as the Eurozone, which can be impacted by this. So next week's news is going to be very important. So I think that anyone that's trading the levels, especially range traders, if you want to trade a range, you can fade the bulls here. That 112.64 would be a great selling area, and as far as a buying area, it would be around this 111.78 pivot, and the 111.35 being the extreme. So to recap that real quick, in the longer range for this currency, for the bears, if you can take out that lower pivot and take out that lower sloping blue line, then we're looking at a market that has potential to get down to 109.5, 109 even over the next month and a half. I don't see it coming because of what we have in the, geopolitically coming over the next week and a half. And then for the bulls, if you can get a rally above 112.64 and take out that high at 113.5, then you really have something to work with and you have a higher trending market going into the rest of the summer. Once again, I don't think that's going to happen, at least until after we pass the G20 meeting and get past the US holiday. So now let's look at the pound US dollar. The British pound US dollar is starting to get a little pop over the last 2 sessions. This chart is from just about a half an hour ago, so you can see today that it's on its second day of positive trading, even though it's coming off of its lows. That's nice to see because this market has been beaten up for a while. So we have that critical monthly support level. The market fell just short of touching yesterday at $1.2486. That would be an area that if the market was to turn back below after this FOMC meeting or over the next couple of days, that would be a very strong indication that this trend is just going to continue until they have new leadership in the UK. And it also would go against with the dollar index. The dollar index bulls take that higher than, once again, the British pound, just like the euro that we were just talking about, or what are the key components in the dollar index. So a strong dollar would be indicative of this trend continuing to the downside. So if you're bullish, be very careful about picking your levels and definitely watch out for the dollar index, because if the dollar index is rallying, you're definitely trying to catch a falling knife if you're buying the British pound US dollar currency right now. Now, as far as being a bear, that's something that you have to be careful with too, because the dollar index is on an extreme. We've seen how it's rallying. If that turns even remotely, then that would most likely give a boost to the past 2 days positive trading action and give us probably a run up towards that downward sloping blue line. Now, the only reason I would say that we would get any really strong move to the upside with the pound US dollar would be if the dollar index turns. In the wake of what's going on with Brexit and everything else, this market is in a bear trend. And I think that that is something that you have to really leave on the table until there's any news that would give us a reason to start to really get bullish the pound US dollar. So even if there is a strong dollar, I think that what you're going to get is a corrective move higher with the pound US dollar, not a change in trend. Like when we looked at the euro US dollar just now, there's a potential if the dollar turns for that to actually start to be a neutral to higher trade. With the pound US dollar, I think what you would have is a range trade that's going to start to establish, where maybe yesterday's low may even be the low for a while. So that UT1 is our first upside target level at $1.2760. So if the dollar index does turn, I think that the pound US dollar has a good chance for the bulls to, like I said, challenge that downward sloping blue resistance line. And once it gets above that or closes above that, then there's a high chance that it would go to that first upside target. Now you'll notice that that target is actually would not make a newer move high, because a few sessions before that is where there is the last high. So if it hits this target or falls just short and then retreats, that's a good indication that the pound US dollar is establishing a new range base. If it rallies above that upside target number one and takes out that high from a couple sessions prior, then that is a bullish indication of, first of all, you have a higher move high on an intermediate trend, and then most likely you're going to see the market try and make a run for that upside target number two at $1.2863. Now, here's another thing to take into consideration. Those two pivots, those two levels I just gave you at $1.2760 and $1.2863, you're talking about a one handle, $1 move in the currency, in the British pound US dollar. That is not necessarily the biggest move to be looking for as far as being bullish. That's actually very small expectations. So if you're bullish, remember, we're not looking, if there is a corrective move higher, and that's the way I would look at it, have your expectations very rational. Don't be looking for an explosion above that, especially at upside target number two. Reason being, even if the dollar index was to collapse, I think that the extent of what that impact would have on the pound US dollar would be around that trading range, even if the dollar index would continue to retreat after it reached that level. Reason being is that because of the leadership issues, excuse me, and the Brexit issues, I think that there's only so much upside potential in the pound US dollar going into that type of situation. So with that being said, let's just key this off again for bulls and bears. I think that that critical monthly support level, that is a great baseline to use as a, for sure. I mean, yesterday's low is, I think, the best risk level, but right below that is that critical monthly support. If you're bullish, I think that would be a very unwise idea to be bullish below that area, because that means most likely, like we talked about earlier, the dollar index is rallying, the dollar is strong, and pound strength cannot overwhelm dollar strength right now. And then also, if you are a bull, have you irrational expectations as far as what you're looking at, and that still is a good move, because right now the market's around $1.2580. So you're looking at, you still have a good dollar move to the, or excuse me, $2 move to that first upside target, and even $3 move to the second upside target. So for longs that are trying to stake a position for the next like week and a half to 2 weeks, that would be definitely, you get some good bang for your buck if that actually occurs. I don't see, like I said, the market rallying above that first upside target, and it may fall short of it because of all the news as far as the G20 and then the Brexit and what have you. So unlike the euro US dollar, it's a little bit more stable, and other currency crosses that could catch a trend. This one is an overall bear trend, so I think the neutral idea of heading into that kind of a basing situation is most likely the scenario that you'll see happening over the next 2.5 weeks to a month and a half as we go into our blooming summer trade. So now with that, let's move on to US dollar Swiss. Okay, so once again, the US dollar Swiss has been rallying for the past week and a half, 2 weeks, and as of today, it has had a nice little sell-off. Now, once again, we talked about the dollar index. Dollar index was made newer move highs today, but then it came off of those highs. This is kind of reflective here with US dollar weakness in the Swiss. Now, the Swiss is one of the major currency crosses against the dollar, but it's not talked about that much. It's much more stable than the other ones and not quite as reactionary to geopolitical events globally or even within its own trade zone. But it is a very good indicator of what the dollar may do in the future. There's typically a lead with the Swiss, and it's also for whether it's just basing or for turning. So a negative trading rate that we have right now going into the FOMC meeting, it's kind of like a little indicator that big money is looking for a US dollar sell-off after the meeting. Is that a big deal? Maybe not, maybe so. Right now, the high today was took out the high of yesterday, which was just above parity, and now it's trading right around this 99.76 level. So parity, besides being psychologically a level, is also a key support and resistance pivot. So the fact that yesterday it pierced it, settled below it, even though it was positive, today it pierced it again, and now it's trading negative. That right now, if that scenario is how it ends up at the end of the day going into tomorrow's session, is most likely an indicator that US dollar strength was going into this Fed meeting, and once it's over, that's when profit taking is going to happen. And that's something you need to also consider, is that a turn in the US dollar right now, where the dollar starts to get weak against all of your basket of currencies, especially your major currency crosses, is not necessarily negative to the dollar. You're looking at the dollar that's already high to begin with. It was higher, obviously, a year ago and what have you, but currently with the trend, it's in a bull market. So you have to look at it as corrective. So right now, if that's the case, and we have a little correction in the dollar, this is a lead here in the US dollar Swiss, which means that most likely the bears are going to test that lower pivot at 99.28. Now, this is also a big deal, because if that does occur, let's say that today's a little higher high than yesterday, let's say that's a short-term high for the next week and a half to 2 weeks. That means that this was a corrective rally that's happened over the past 2 weeks. And that being said, means that the bear trend is in place in the US dollar Swiss trade. And if the bear trend is in place there, that means that you most likely are seeing a corrective rally in the dollar index, which may be neutralizing that. So that's a good indicator for your other currencies if you are not trading the US dollar Swiss, but if you're looking to gauge US dollar strength, especially like the past two that we talked about, the euro US dollar or the pound dollar, that would be a good way of gauging whether or not you're trading on the right side of the market. And also, if there's a turn in the US dollar Swiss ahead of those other currencies, you should be most likely mindful of what's going on with that maybe your position is probably not going to hold up. So the Swiss franc may be a good indicator for the US dollar directional bias into the rest of the summer, especially with the G20 meeting going up. Now I see, just like we were talking about, a range trade situation. Besides the fact that it's FOMC day today, I'm surprised that there is this much of market action in the Swiss. I do see that the market's most likely going to settle into a range trading area over the next week and a half. So let's look at this key directional pivot at just above parity, and then also at 99.28. I think that's going to be your target trading range for the next week and a half going into that meeting. Anything's possible. Now, that being said, those are key levels to watch out for. A rally above this, just above parity directional pivot, that is a bullish indication that the US dollar actually is strong. So that would mean, if you're watching the dollar index, like we looked at the beginning of this webinar, that market will still be rallying. So a dollar index rally most likely will carry the US dollar Swiss above parity. And that being said, that would be a very good indicator that the dollar is strong. And then you're most likely going to see the dollar Swiss over the course of the next few weeks, going into the middle of the summer, probably go above the parity level up towards that a $1.01 area to a $1.01.5. That would take most likely a couple weeks. The Swiss can have radical moves. If you look at the two pivots that we have here, these two yellow lines, the market had 1 day alone that encompassed that whole pivot range. So that the Swiss can move, but typically on any given day it doesn't, and I don't see any radical reason for it to have a major upside burst of action unless there was a major move in the US dollar index. So that being said, you can see that those two pivots are most likely your target range for bulls above that upper pivot, You're looking for a breakout. And for the bears, that major support level is a major support level. That is key, because that is basically the basing area for a range trade, or even a basing area if the bulls are to really get a new move higher that's strong, where you have true buying support. A failure at that 99.28 level has the market leaning on that lower rising blue line, which is a monthly trend line. It's a key monthly trend line as well. If the market was to fall below that line, then you're looking at the low that was set about 2 weeks ago to be in jeopardy. If that low is taken out, that means, once again, we get back to our dollar index. Dollar index is falling apart. So that's why we're looking at that as an indicator for right now. There's a good harmonic rhythm going on between the dollar and the major currency crosses right now. The dollar index, now sometimes there's a correlation that you can use as a 1 or 2 days as a pivot for turning points and trend. And then there's times where it's just choppy and it's very unreliable. But right now we happen to be in a situation where there are very good harmonics, where a turn in the dollar is a really good gauge from the index, that is, for these major currency crosses like the pound and the euro and the Swiss. So with that, let's move on to our next slide. Here is the US dollar Japanese yen. This bear continues to pressure the currency cross to lower levels. Right now, ironically, we have the other ones we just talked about. Harmonically, they're in motion. I don't know if that's going to impact this one. This one is a head scratcher. Like those other markets, like we looked at the dollar index, the pound, the euro, and the Swiss. They've trended over the past few months either up or down, even in a tight range, but they had trending action. This market here got slammed into the beginning of June and has settled into a range trade that is just ugly. I mean, if you look at that, that looks like if you're looking at a futures contract at a back month contract as far as the trading range, because of lack of volume and what have you. So I don't know what's really going on with that. That is a very ugly trading range. All I know is that anyone that was trying to buy or sell the US dollar yen over the past week and a half, if they're intraday traders, they must have gotten chopped up. I can't see how anyone made money unless you somehow were trying to trade the low volume and high volume the range. So with that being said, the dollar index strength, if that is the case, would have the US dollar yen finally turning, getting us a rally that would get us above, see that downward sloping blue line, a rally above that, or time right now, it's going sideways. Just time alone is going to have the market get above or through that line. But that doesn't mean that it's going to go up to that first upside target or even that second upside target. Those are bullish targets if the market does start to gravitate, and if US dollar strength continues in the US dollar index. That's where I could see that the US dollar yen could get back up to that 109.018 level, or that 109.687 area. That, I think, would be the extent of what you would see for a US dollar yen rally. The market's in a bear market, and until the US dollar, or excuse me, the US and China trade thing gets balanced, I think you're going to see the US dollar yen pretty much hang where it's at. There's no reason to see the dollar strength really carrying this market even higher. And that's what I mean. We were talking about the US dollar index. If the US dollar index does rally, that would most likely help to lift the US dollar Japanese yen. But I think that proportionately, you won't see as much upside action in the US dollar yen as you would in the other currencies that we talked about versus the dollar. I really think that it will be contained. I think that the trade battles and tariff wars definitely are keeping that in flux, because right now Japan has been benefiting from the tariff wars, because as markets correct, more products are being bought in Japan and other Asian countries versus China. So that's good. But Japan has a lot of other issues that are going on, and I think until the trade war is balanced out and figured out between the U.S. and China, I think the US dollar yen is going to remain neutral to lower no matter what. Plus, there's other variables that would have that would impact that as well. So now here we have this lower dashed major support pivot, and that's from the current low that was set a week and a half ago. if the bears were actually able to get a slide down to that area and pierce that and fall, and especially close below that 107.803 area, I think then obviously the bear trend is in motion again, once again, and then you'll probably see a leg down again, taking the U.S. dollar yen probably down towards that 106 to 105 half area actually. That would mean that U.S. dollar weakness is driving this market. And that is why I think that the bears have a good shot at actually getting the biggest bang for their buck. Bulls, only if there's a big turn in the dollar and dollar strength, which, like I said, from looking at the dollar index and looking at the other currencies, I think at least in the short run, the dollar is going to have a little bit of a turn negative, meaning a boost to the other currencies. So if that's the case, then, well, you're going to see the US dollar JPY continue to go lower. Only a change in the dollar index strength, like I said, if it was to make newer move highs and what have you, that would give us the chance to go towards that upper trading, or excuse me, upper target 1 and upper target 2. And that would be the extent, I think, that any move you would get to the upside. And as far as taking out that lower purple dash line, that breaks there, then that means that US dollar weakness, that means the dollar index most likely is turning, those other currencies are rallying, and then this one would be breaking. And then as far as how far that will go, who knows? Like I said, I think that in the short run, you're going to see a dollar index correction, not necessarily a dollar bear. So that being said, it would just take this market lower to, like I said, those first areas of like down towards that 106 even, or even 105 half area. And that would be a balancing area again, where you probably see with this recent little 2-week period of really negative type of, it's a negative trading environment, not that it's negative the currency you're trading. It's just, it's tough to trade in that market. I mean, just looking at that, I can just see, like, I can feel the pain of like thousands of traders out there being like, why was I buying or selling this? For whatever reason they had, they were just putting money on the table. And even if they didn't lose money, they were just sitting watching a position go nowhere and not giving, they were looking at the risk they had on and being like, wow, I have my risk here and look at what's going on. Absolutely zero. And that's probably what you will see develop if the market, well, when, excuse me, not if, but when the market either rallies up into those upper trading areas or upper target areas, or falls below that purple line and then reestablishes a new base somewhere else. So as a recap, I think that the main things all you Forex traders and currency traders need to pay attention to is the G20 meeting that we're heading into next week. We're also heading into, we have this tariff war that's still going on, pay attention to that. But the dollar index, key off of that market. Just I always tell traders, like, just because you're trading one market, sometimes you need to look at another one as an indicator. And I think that technical and fundamentally aside, that right now, one of the best things that any currency trader can key off of is the dollar index, but not on a daily basis, look at it on a trend. So if, like I said, the dollar index starts to rally and continue what it's been doing, expect pressure on your major currency crosses. And if it doesn't, which, like I said, I think it's ready for a nice corrective break, then here we go. We got a nice trade for the contrarians against the dollar and your other Forex currency crosses. So with that being said, do your homework and make sure you take a look at the markets, weigh your potential trades, have a plan and stay the course, use definitely proper risk levels, and have a plan. That's the biggest thing. So I'm Teddy Kekstadt from Forex Trading Unlocked. You can find me at www.forex-trading-unlocked.com any day of the week. You can like, follow, and share us on LinkedIn, Twitch, and also on StockTwits. And if you like the analysis that you heard today from me, coming up on a 3-year anniversary of a book I wrote that's available on Amazon and on Kindle and paperback. It's called High Probable Japanese Candlestick Patterns. And then we talk about correlation trades and all types of other ways of trading the Forex markets and other markets. And you can utilize the best buy and sell patterns used for over 400 years to help give yourself a competitive edge against the markets. And with that, everybody, good luck with your trading. And I would say don't do anything until the Fed meeting's over, unless you're already in the market, or even wait for the close and reevaluate and see what's going on with that dollar index. With that, everybody, have a great day. Thank you very much.